Good afternoon, everyone. Thank you so much for joining us. We're having a few last-minute people filter in here, so we're just going to give them one more minute, and then Rob will go ahead and get started, okay? A little bit of housekeeping as well. If you have any questions during the presentation, feel free to write them into your box there, and I will make sure that we get to them at the end. The presentation will be available to you after Rob is finished. We'll make sure everybody gets a copy. Also, you can rewatch Rob giving the presentation on our website, and I will make sure to send out that link when we're all done. Thank you so much for joining us. Just a few more seconds here.
Am I on, Allie?
I hear you're all good to go. Thanks.
Good morning, everybody. Thank you for joining us on our long-term care presentation. I'm going to give some context to the presentation that you're going to see. One, this is a presentation that we have used with retail clients in a seminar situation and small group situation. It is a comprehensive overview of long-term care, and quite frankly, the industry is trying to transition from long-term care to extended medical care. But this presentation, if you would like to have this to use with your clients, if we can assist in any way we can, this can be personalized to your firm, your logo. I will caveat that with it. You will need to get it filed with your broker-dealer's compliance department. I got it through my compliance department with no changes, no comments, which was miraculous. So it's available. I will be addressing this as if I were speaking to a retail group. The information is all as relevant. If you have questions, we'll have a question and answer at the end. I hope you find this informative and you learn something new by the end of the presentation. Understanding long-term care. Our opinion is that for most people in the marketplaces that we're dealing in, the semi-affluent and even the affluent marketplace, the greatest unknown expense that people face is some type of a catastrophic extended long-term care incident, medical care incident after the age of 65. Typically when most people's earning years are over, they've got a budget and a lifestyle that they desire, a drawdown rate on assets or commitments to any income that they have coming in, and that this unknown expense is the greatest risk to upsetting or knocking out of balance their long-term financial plan. So questions we're going to address in this presentation is what is a long-term care event? What's my plan and how do I integrate my extended care plan into my retirement planning? How would my spouse or loved ones be affected physically, emotionally, and financially if I needed care? What are the benefits of acting sooner rather than later? What will Medicare and Medicaid cover? There's a lot of people who just have completely erroneous perceptions about that. Even if I can afford to self-insure, is there a smarter way to plan for this? How much could this cost? Do my spouse and I agree on a strategy to deal with an extended care event? Would my kids be able and willing to care for me? How would I know when to get professional care? And I'm healthy now, so I can just ignore this and wait until I'm older, right? So the agenda is addressing living a long life. What is long-term care? Protecting relationships. What are the costs? Who pays? Addressing the favorable tax treatment and the types of long-term care plans are available. The last two items most people don't know about, and there is a lot of information and options available, and I think that will be where most people learn something new today. Living a long life. You know, if you had all the time in the world, how would you spend it? Most people spend time with their families, volunteering, enjoying a hobby or whatever recreation they like to do when they're not working. The life expectancy at age 65 off the Table 5 mortality rates is age 85, 21 years. For a couple age 65, there's a 50% chance one will live to age 92 and a 25% chance one will live to 97. Unfortunately, when we live a long life, we may need long-term care. You know, what are the risks? You know, you're planning on living a long life, but the reality is you or your loved one could need long-term care, and this could affect your lifestyle, your family, your retirement, and your goals. In the year 2020, some 12 million Americans are expected to need some form of long-term care. Because women generally outlive men by several years, they face a 50% greater likelihood than men of entering a nursing home after the age of 65 and not having the support of a spouse to help them. 68% of people over the age of 65 will need this type of care before they die. 68%, 2 out of 3. When I'm in a group setting with a seminar, I ask the people to look to their left and look to their right and figure out which of the 3 are going to need long-term care. 5.7 million people are diagnosed with Alzheimer's now, and it's projected to be 14 million by 2050. Long-term care in all 5 sectors, the user of long-term care services are overwhelmingly women. Adult daycare services, home health agency services, hospice, nursing home, and residential care communities. Again, the men die. The women help take care of the men die, and then when the women need help, their spouse isn't there to help them, and they live longer. Yeah, I hear what you're saying, but that won't happen to me. If someone told you that you had a 2/3 chance of something occurring, you're betting that you're going to be the 1/3 that it doesn't happen to. It can happen to anyone at any time. It could be the result of an accident. It could be just some random event on a sunny Tuesday afternoon in the middle of the month. LTC is not necessarily an end-of-life event. Many times long-term care is a short-term event or a mid-term event where there's been some type of a catastrophic medical situation and the individual needs a substantial amount of time to recover and rehabilitate. Many long-term care needs are temporary. 70% of people over the age of 65 will need long-term care services. 3.9 years is the average length of a long-term care claim lasting longer than 1 year. The statistics on each of the bands is below. And the average life expectancy of a person with Alzheimer's diagnosis after the age of 65 is 4 to 8 years. And I've known people that have lived 12 and 14 years with a mental health impairment, or a memory impairment. So what are the chances? If someone said there was a 50% chance your house was going to catch fire, would you insure it? 0.317% of households experienced a fire in 2010. Or we could say that 0.276% of housing units had a fire in that year. The lifetime chance someone who buys a policy at age 60 will use their policy before they die is 50%. So 50% will use their policy and 50% won't. The actuaries base this upon a 0-day elimination period, which means benefits start from day 1. What is long-term care? The care you need when you are no longer able to care for yourself independently and stay safe. A chronic illness event requires you that you are required. A chronic illness event requires that you are unable to perform 2 of the 6 activities of daily living without substantial assistance, and the condition is expected to last more than 100 days. That 100 days is a key number in the whole long-term care discussion. This can occur from accidents, a medical condition, aging, sickness, or severe cognitive impairment. What are the activities of daily living? Continence, transferring, toileting, bathing, dressing, and eating. These are the officially defined activities of daily living, and you need to, typically on most plans, you have to need assistance with 2 of those to qualify in a long-term care insurance policy for assistance. Where can I get long-term care services? You know, back in the day, most people thought of long-term care as you go into a nursing home, a full-scale nursing care facility, and that was, you were either in or out. It was black or white, on or off. Long-term care today is a far more diversified set of parameters in which people need assistance. And most of it is going to take place in the home where most people prefer to take place. But many years ago, traditional long-term care policies didn't even cover home health care. It can be an assisted living community, an adult daycare facility, a nursing home, or hospice care. All of these places where someone might go to get long-term care assistance can qualify for financial assistance from private insurance policies. So it can be received at home, in the community, in an assisted living facility, or a full-blown nursing care facility. It's also about your relationships. The number of people I know, I'm 53, I'm in that sandwich generation. The number of people I know who have taken care of their parents in some capacity in the last 5 years, sometimes it's a little overwhelming. And, long-term care isn't just about you, it's about your loved ones and taking care of your loved ones. And we ask people, one of their greatest fears in retirement is being a burden to their families. Well, this is what it is. This is what being a burden is. 46% of family caregivers report that providing care affected their personal health and well-being. How could it not? It's a second full-time job in your life. 53% of caregivers and recipients report that they lost income due to the demands of providing care. Time off work, unpaid time off work. 50% experience a negative mood, including depression, mood swings, and resentment. Well, if you take the first 2 and add them up, the third one's not very difficult to understand. Who do you love? Long-term care equals loving the caregiver. It's about providing them some of the resources and means to be able to provide long-term care for their loved ones. What kind of support, financially or caregiving, are you providing for the benefit of your spouse or another adult? Just think about your own family's life experience. I know on this call, we have a large group on this call. I will bet that at least 20% of the people on this call have a real personal experience with what we're talking about today. And what has been the emotional, physical, and financial cost of caring for someone? We all want to take care of our loved ones. They're our loved ones. But it's not easy, and what is the lifestyle of, and where do your children or your other family live now? So think about where your parents are. Where are your children now? Are they down the street? Are they across the country? And how important is family harmony to you? It puts a tremendous amount of strain on the family, and if there's multiple siblings and mom or dad or both need help, it puts a tremendous amount of strain on those relationships as well, particularly if one sibling's halfway across the country and one sibling lives down the street from mom and dad, and all of the things that go along with that. And what are the hidden costs of long-term care? We're not talking just about money, but there are other costs as well. Women live an average of 5 years longer than men. Women who provide unpaid care lose an average of $565,000 in income and retirement benefits over their lifetime. Now, when I first read that seemed fantastic. But that's from the Minnesota Women's Press on November of 2013, so the number might even be bigger now. It's because, who's going to be the caregiver in the family situation? Usually it's the female in the relationship. They may have to temporarily give up a job, and it's not just the salary they forego, it's the retirement contributions and all the things that go along with it. 40% of seniors caring for a spouse will predecease their spouse they are caring for. So you have mom and dad, mom's taking care of dad, and mom predeceases dad. Now who's taking care of dad? Family caregivers are well-intentioned but ill-prepared, and the loved one for whom they're caring for may get less quality care. There's not a lot of classes out there you can take about providing long-term care, and even if there were, how many people are going to go get trained on how to do many of the things that are involved? People fly blind when faced with these events. Women are affected most by the impact that long-term care can have on a family. Men feel the impact as much as women when it comes to financially preparing for future health care. And family harmony could be disrupted and relationships strained. I've given several examples. These are the intangible costs, the emotional costs, the psychological costs associated with long-term care. And for many people, those are far higher costs to pay than mere dollars coming out of a checking account. It's up to you. The good news is you have some control. You can't control if you need long-term care. You can't control when you may need long-term care, and you can't control how long it's going to last. You can control the outcomes and how the family you love are impacted. It requires planning. So let's look at the financial costs. In 2017, average home health care and 51% were provided in the home, $49,188 a year. In 2030, it's expected to be $72,000 a year. Community care, $45,000 a year in 2017. Skilled nursing facility with a semi-private room is $85,000 a year. Total length and cost of care, in the home 1 year, assisted living 2.5 years, 59% will be transferred to skilled nursing. Skilled nursing 1 to 1.5 years. Cumulatively, in 2016, that would cost nearly $290,000. When we go to all the workshops we go to with financial professionals, and they talk about these expenses, and you see, you need to anticipate $260,000, $300,000 of unpaid or unreimbursed medical expenses. This is what they're talking about. I mean, I go to these workshops, and I sometimes the numbers are overwhelming. But again, these are facts and statistics. We're not just making this up and pulling them out of the air. The $290,000 number, if you think about your clients, however wealthy they are, that's still a pretty big number. And what's your plan? This is about proper income planning, not asset planning. How important is certainty to you? How have you planned for any of these events that could affect the retirement plans and goals for yourself and your spouse? And that's the other thing, they might have enough to pay for the first spouse and leave the second spouse destitute. And they might be alive for another 20 or 25 years. What written plan is in place to provide directions to those family members who will be assisting you? You may have a plan in your head about what your family is and isn't going to do for you. Do they know that you have that plan? Have you shared it with them? Have they agreed to do it? Would you prefer your family provides care or supervises care? This is the type of planning you do because you love someone else. Again, long-term care planning isn't about the person getting the care. It's about the people that person cares about. Who pays? And this is where a lot of people have some misperceptions. Long-term disability, some people, I have long-term disability. Well, that covers your lost income, but it doesn't pay for any of your long-term care needs. And often when your job ends, so does your coverage, and typically it goes away at age 65. They're extending that out on some plans to age 67. Medicare covers only a portion of long-term care costs up to 100 days. 20 days are at no cost, and the remaining 80 are at a significant copay for the insured. It's about I don't know the exact number today. I think it's $178 a day deductible for the second 80 days. And there's a stipulation for you to qualify for that assistance that you would be hospitalized for 3 nights prior to discharge to a long-term care facility. I don't know why that rule exists, but you need to be in the hospital for 3 midnights and then discharge to a facility, and then Medicare will pay the first 20 days and then 80 more days at a deductible. Health insurance does not cover long-term care expenses. Medigap policies are health insurance and also do not cover long-term care expenses. You can self-insure, and this is what most people think they're doing. They're going to self-insure. Assets used to pay for long-term care can deplete future income for your spouse, as well as drain the inheritance you plan to leave for your family. This is the greatest single disruptor to people's long-term financial plans after the age of 65. And the other option is family members. Even the most responsible are not always prepared physically, emotionally, or financially to care for loved ones. 53% of Americans who care for a loved one lost income due to the demands of providing that care. You know, if you're depending on your children to provide the financial support, well, they may not be able to. And if you really haven't discussed it with them, that's a hope. So what are the sources of funds for long-term care expenditures? Medicare covers long-term care expenses for individuals with countable assets of $2,000 or less, and care could be limited to a nursing home chosen by Medicare, not your family. You have to deplete your wealth. You know, people come to us and talk to us about Medicaid planning, and, you know, I have a flippant response. I'm like, you know, we're wealth advisors. We're not poverty advisors. If you're looking for solutions and how to plan and deal with long-term care, fine, but we're not in the business of helping people deplete their assets so that the government can pay for their long-term care expenses. The other thing is that states are becoming much more aggressive about recovering those expenses. For example, they'll let you keep your house, but you're going to sign the deed over to the house so that once the second spouse dies, the state gets the house to help recover the cost of providing your long-term care. And in some states, they are passing laws where they can actually go after the children for the expenses they paid on behalf of the parents. I'm shocked that the laws exist, but more and more states are passing these laws that require children to be financially responsible for their parents. Payments for long-term care insurance. The long-term care insurance industry paid out $10.3 billion to 303,000 claimants in 2018. There's been, you know, there's a lot of turmoil in the traditional long-term care space, but so far, not one of the carriers that has issued policies in the past, you know, the biggest ones, you know, John Hancock got out, MetLife got out, Guardian got out, Unum got out of the private marketplace, but they're still paying and honoring their claims. Benefits of private long-term care insurance. It provides certainty in your planning and outcomes. It avoids physical and financial dependence on your family and friends. It protects your hard-earned assets. I talk to RIAs and I say, listen, do you buy options to protect your clients' downside positions in their portfolios? Do you do things to hedge the downside risk? Well, of course we do. Well, good. If you knew that there could be in your client's $1 million portfolio that after the age of 65, there's a 70% probability that there'd be a $300,000 downturn in their portfolio, would you do something to hedge against that risk? Assuring high quality care at an affordable price. Maintain choice on how and where we receive care. It gives you more options to stay at home when you need care, maintain your independence, maintain your family harmony, enable your family to supervise care instead of being the providers of care, and it transfers the risk and responsibility from you and your spouse and your family to an insurance company that's built to do it. Favorable tax treatment of long-term care payments. So in the Pension Protection Act of 2006, the federal government recognizes this wave of expenditures coming down. And when they're doing calculations for long-term medical expenses for Medicaid, the greatest single item that balloons that long-term deficit is providing long-term care for large swaths of the population. So in the Pension Protection Act of 2006, they put provisions in there to entice people to buy their own long-term care. In the Affordable Care Act, they tried to price in a long-term care model where everyone was going to contribute $25 or $50 a month towards this long-term care pool, and they would have some long-term care coverage. The actuaries couldn't make it work, and they abandoned it. So the government recognizes that they need people to start funding this on their own, and they provided in the Pension Protection Act of 2006, even before the Affordable Care Act, they put provisions that allow for some tax deductibility of long-term care expenses. So for an individual W-2 wage earner, it counts as a medical expense and is deductible to the extent that other medical expenses are deductible. So it amounts in excess of 10% of your AGI, and actually the 7.5%, we need to remove that 7.5%. It's all 10% now. You can deduct those expenses, and you can deduct long-term care premiums to a certain extent above that threshold. If you're self-employed 1099 wage earners, 100% of the premium is deductible. There's no 10% threshold to meet. And you can also deduct dependent and spouse premiums. Now, there's going to be some banding limitations on what is actually deductible. We'll get into those. For partnerships, LLCs, and subchapter S, for the owners, it's the same as a self-employed deductibility, but you can provide for your employees a 100% deductible long-term care benefit with no imputed income to your employees. And there's not limitations on that deductibility at the corporate level for that benefit. For C corporations, 100% of the premium is deductible to the corp, and it's the same for the owner as it is for an employee. So you don't have, C corporations can pay for the owner and their spouse's long-term care benefits, and it's fully deductible. And it's not subject to non-discrimination rules. You can pick out selective employees and put them in a plan for long-term care. The other thing that they provided for is annuity gains. Annuity gains can be accessed income tax-free to pay long-term care premiums. And they can also be accessed to provide for long-term care expenses. And we're going to get into some options that products that carriers have come out with where you can actually get leverage on those gains to create a larger pool of long-term, tax-free long-term care benefits. So the potential for tax deductions, individual taxpayers can treat premiums paid for tax qualifying long-term care insurance for themselves, their spouse, or any tax dependent as a personal medical expense. This is not tax advice, so please speak with your CPA for specific rules that apply. But if you're 40 or less, you can deduct up to $420 of expenses. And again, it's banded as you go up as you get older. Now, at 40 or less, 420 may not seem like a lot, but when you're 40 buying long-term care and you look at what the total cost would be, it's not an insignificant percent. But when you get over, you're over age 60, you can deduct $4,400 a year. It helps. So it's not your parents' long-term care anymore. There are now a large spectrum of solutions available, from traditional long-term care insurance, and it still exists. There's some good high-quality companies in that market space, and we'll address that in more detail. You can have life insurance that has an accelerated benefit rider for long-term care services. So you have a client that has a need for life insurance, and you can add a long-term care rider in conjunction with that benefit planning need and kill two birds with one stone. And then there's asset-based long-term care and LTC qualified annuities. These are life and annuity products, not long-term care policies, but they are life and annuity products, but they are specifically designed to optimize, maximize the long-term care benefits, not necessarily maximize the death benefit of the life policy or maximize the cash accumulation of the assets inside of the annuity. Things to consider when comparing your options is daily or monthly benefits, what the benefit cap is, what the elimination period is, what type of an inflation rider do you want to have put on, does the plan offer shared benefits, what are your payment options, what are the potential changes to ongoing premiums, are there non-forfeiture provisions, what are the exclusions of the plan, do you buy an indemnity or reimbursement plan? And we'll get into that a little more. And then chronic illness, if it's a chronic illness rider versus a true long-term care rider, is it for temporary or permanent chronic events? And it varies by carrier and varies by product. So there's a lot of issues, a lot of variables to consider. So in traditional long-term care, what are the pros? You get a spousal discount of as much as 10 or 30%. You can build in inflation protection. Some of them still offer up to 5% inflation riders, though I will tell you those are extremely expensive at this point. Premiums may be deductible for traditional long-term care. You can provide some asset protection. Almost every state now has a partnership program where you agree to buy a pool of long-term care benefits of X, let's call it $500,000. In these partnership programs, the state is only going to require you to spend down, they'll require you to spend down all your assets to $500,000, and then you can qualify for state assistance on long-term care. And it gives you the most leverage for LTC expenses for your premiums paid. Generally speaking, in any given year, the traditional long-term care premium will be somewhat less than it would be if you were paying a premium on a life insurance long-term care hybrid or even on an asset-based long-term care policy. What are the cons? You're required to pay premiums until you file a claim. Right now, other than one company that's out there, a niche company that's out there, there are no more 10 pays, pay to 65, 20 pays, 30 pay plans. They're all lifetime pay plans. Again, we do have a carrier out there. They're relatively new to the business, and we have reservations because of that newness to the business, but they do offer some short pay solutions in traditional long-term care. You have possible rate increases. Now, I say possible because you got to say possible. I will tell you, if you're 65 today and you buy a long-term care policy, you need to bank on the fact that at some point between now and age 85, they're going to raise your long-term care premiums. There's been a swath of traditional long-term care premiums industry-wide of carriers going back and increasing their premiums. They are guaranteed non-cancelable policies, which means as long as you pay your premium, they can't cancel it, but they can raise your premiums. And over the last 5 to 7 years, we have seen people's premiums double and even triple from what they initially started out with. Now, I will caveat that with one thing. I have a personal experience. My former father-in-law has a Cadillac MetLife policy. And, lifetime benefits, 5%, 30-day elimination period. I mean, this thing was, I'm like, wow. And he got a notification that they were going to double his premium from $1,800 to $3,600 a year, and he was outraged, and he was going to not pay the premiums. And I said, Gordon, at $3,600 a year, you have one of the best plans. It's a screaming deal. Please do not drop that coverage. I don't care if they raise that premium to $5,000. Keep paying the premium. So even though we're going through some premium increases, and I know for people on tight budgets it's impactful, but those premiums are still, relative to what they're covering, are considered a pretty good deal. And then most long-term care policies are reimbursement only. Some may have a cash benefit feature, and they're use it or lose it. This is the big thing that causes most people. It's like car insurance. If you pay car insurance your whole life and die without a car accident, they don't give you back your money. Well, long-term care, traditional long-term care, and it's one of the reasons why the premiums are somewhat affordable, is if you never use the policy, you don't get the money back. It's gone. It was a pure insurance transaction. So examples, for initial pool of benefits equal to $164,000 each at age 60, the value of the benefits when the policyholder reaches age 85 is $343,000 each. It's a 3-year benefit pool initially providing $4,555 a month in benefits. And these are as of April of 2019. A single male's annual premium is $1,900. A single female preferred health age 60 is $3,000. And the couple combined is $3,400. And people say, why do the women have to pay so much more? because of the statistics we saw earlier. They're 50% more likely to go into a long-term care situation than men, and if they do go into it, they will be in the long-term care situation longer than the men. But if you combine the two, look at the savings. So, and it's great because there's a couple discount. The insurance company assumes one of the spouses is going to be around to help the other spouse, and therefore keep the expenses down. Asset-based long-term care strategies, and we are writing a lot of this business because it's got a lot of pros and it's got some cons, but it really is a solution that's ideal for many people. One, you have guaranteed benefits. Two, you have guaranteed premiums. So the premiums can't go up. Once you enter into the arrangement, the premiums can't go up. There's typically an ability to get your premium back if needed via an 80% to 100% return of premium option. Typically, after 5 years in most of the plans that we have, some of them are day one return of premium, but most of them after 5 years, and you can elect whether it's 80% return of premium or 100%. If it's 80%, you're going to get a bigger pool of benefits than if it's 100%. But you can get your money back. The capital stays in the family if you never use it via the death benefit. Though the death benefit leverage is not nearly as big as it would be in a traditional life insurance policy, there's some leverage where the death benefit will always exceed the original premium paid. It'll pass income tax free to your heirs. It'll bypass probate. It passes by contract, and the asset's still there. It's not gone if you didn't use it. These policies are simple to understand. You can do a one and done premium, or now there's flexible premiums, 5, 10, there's even lifetime pay flexible premium options in this marketplace. But again, that premium's guaranteed not to go up. You can pay with cash, or you can transfer existing assets from cash value life insurance to fund the strategy into a life-based product. Expedited approval process. Many of these are simplified underwriting. There's 5 knockout questions, and if you can answer no to all of them, typically they'll issue a policy within 5 business days. And even if there's a situation where there are some underwriting issues, we have providers in this space that do full-blown underwriting, and we can get people that were declined elsewhere issued at standard on an underwritten basis. And you have the choice choosing between reimbursement and indemnity. Reimbursement is that you file your expenses on a monthly basis with the carrier, and they reimburse those expenses back. The reality of that mechanism is that after the initial 3 or 4 months of the process, the vendors that you're utilizing invoice the carrier direct, and they pay the carrier direct, and you have to pay whatever expenses weren't covered in a given month. Or it's indemnity, where once you qualify for the benefit, they'll start sending you a monthly check up to the monthly dollar amount that you have in your policy, and what you do with that money, they don't care. You can do with it whatever you want. And there's benefits to indemnity versus reimbursement. Why would you do one over the other? And what are the cons? The best leverage is when it's a lump sum investment, but it's not required. Typically requires $50,000 or more in total funding. And there aren't as many options over the age of 70, though I will say with some of the new products coming out over the next few months that we could bump that out to age 74. But look at it this way. You ask a lot of people, what is your long-term? Well, I got 100,000 in CDs. That's my just-in-case money. Well, what if we could leverage that 100,000 of CDs into a $300,000 or $400,000 pool of income tax-free benefits? And what's your CD paying you right now? What's a 5-year CD paying right now? Two. If we're lucky, so it's generating $2,200 of income a year, and after taxes, you're netting what, $1,800? Where you could provide a $300,000 or $400,000 pool of long-term care benefits for $1,800 a month or $2,000 a month. Wouldn't that be a great thing? Examples of asset-based long-term care: you're married, 65-year-old female, repositions $100,000 as a single premium into an asset-based policy. At issue, you get $4,275 a month in benefits, a $331,000 total pool. At age 80, it's inflated to $6,600 a month in benefits and $516,000 total pool at a 3% inflation rate. If it's never used for long-term care expenses, the death benefit at issue is $164,000. It does decline over time, and at age 86 to 120, it's $102,000. You maintain liquidity. It's an $80,000 surrender value in all years. 0-day elimination period. This is an example of a reimbursement plan. You also have accelerated benefit riders on traditional life insurance. Again, you got a client that needs life insurance. For example, you have a doctor and you're using an overfunded VUL policy as a supplemental retirement plan, funding it like it's a super Roth IRA. You could also tack onto that death benefit a 2 or 3 or a 4% monthly long-term care benefit. It doesn't, and the difference in the cash value and accumulation aspect of it is really negligible over time. Sometimes I'm shocked when I see how little of an impact that added cost has. What are the benefits? One, you have guaranteed benefits, you have guaranteed rates. Typically will generate the largest long-term care monthly benefit from day one of all of the plans, although it typically has no inflation rider. It'll provide the largest net death benefit to your heirs if you don't use it. The premiums are never lost. They're leveraged via the death benefit. This is where you have the most flexible funding options available to you. Again, you can pay for it with cash or can transfer in existing policies from another life policy. And in many cases, many of these plans provide an indemnity benefit versus reimbursement. The cons are surrender values could be less than the premiums paid. If you're using a pure GUL guaranteed death benefit scenario, you might not have any cash values in the policy going forward. It's just term for life. But if you're using it in an overfunded supplemental retirement accumulation transaction, you'll have your cash values there. And it's a fixed benefit pool. We don't have any of these plans that provide for an inflation adjustment to the benefits. But again, the pool starts out larger than any of the other pools with any of the other funding options. So an example, we have a male age 62 with average health, purchases a $250,000 total death benefit, and it's both the benefit and the LTC pool. Premiums and benefits are guaranteed to age 100. It's $6,600 a year annual premium, $10,000 monthly benefit for long-term care. If it's paid for as a reimbursement plan, there's little to no cash value. This is a pure GUL term for life transaction. Premiums are no longer required once you go on claim, and the IRR rate of return on the death benefit is 7.4% at age 80. In carrier number 2, $6,200 of annual benefit. This is using an indexed universal life policy where the death benefit might not be guaranteed, but you have substantial upside potential on cash value. And it's an 8% IRR at age 80. And again, premiums no longer required at claim. So there's options. I mean, and it's how much risk, how much certainty do you want? How much risk are you willing to accept? And then there's long-term care qualified annuities. You can 1035 an existing life or annuity policy with gains to a tax-qualified long-term care annuity. Before replacing your annuity through a 1035, please consider whether there are surrender charges on the existing contract and any new surrender charge schedule on the new contract. But you can access the gains income tax-free to pay for long-term care premiums and or expenses. Now, it has to be one of these it has to be an annuity that was designed to be in compliance with the Pension Protection Act of 2006. More and more carriers are coming out with them all the time. You can leverage the cash value into some multiple. We've got ones where the multiple's 2, 3, even 4 times leverage on the annuity. And if you never use it, the annuity value passes to your beneficiaries just as any other annuity would. And that we also have options here where you can use qualified funds to plan for it. We have one option where they will take the qualified funds and they will convert that into a 10-year payment stream to fund into a standalone asset-based long-term care life policy. And you say, yeah, but we've got to pay taxes on those distributions. Yes, you do, but they're given a 20% bonus on the income stream coming out of that annuity. So if your client's in a 20% or less tax bracket on the transaction, it'll mitigate the taxes. And they even have one where it's just an annuity with leverage. And you can put an extended care benefit rider on it. Now, the first dollars out are going to be the actual dollars from the IRA. So you put $100,000 in, you get a $300,000 pool. The first $100,000 coming out are going to be taxable. but that second $200,000 that's going to be needed come out income tax free. So an example of a qualified annuity, we have a female age 70 transfers money via a tax-free exchange 1035 from a non-qualified annuity valued at $300,000 with a $100,000 cost basis. You've got guaranteed values in the contract. At issue, you have a $12,400 a month in benefits for long-term care, 132 months of benefits, 11 years, a $1.6 million total benefit pool, and a $279,000 cash surrender and death benefit value. So you are giving up $21,000 there towards the riders. And at age issue, the benefits go down a little bit, and the surrender value goes down a little bit over time. But there is still a substantial leverage. You're taking $300,000 and leveraging it into $1.5 million of income tax-free long-term care benefits. So what's the process? So when we're meeting with people, you know, what is it? What's the process to go through? One is find out if it's important to you and what outcomes you want. Is it important to your clients to not be a burden financially, emotionally, physically to their family? You know, identify what resources they have. We have comprehensive cash flow modeling. Can the client afford the solution? What's going to happen if they don't have a solution? You know, we can provide an analysis and inform the client of their options. Be an advocate in the marketplace to identify the best and right strategy. We have at Core Group all of the best options in the marketplace available to us today. And when you bring us one of your clients, we're going to compare all of those options. And what are the, do they want indemnity, reimbursement? Do they want a larger pool now? What is it that they want? We will provide an analysis showing all of those carriers and all of those options and lay them out, including traditional long-term care, asset-based long-term care, rider-based long-term care on traditional life insurance, and help your clients identify the best solution for them. We'll discuss the options and demonstrate which one best accomplishes what they wanted to do. And, once they agree on a strategy, we navigate the approval process to get the best solution at the best price as quickly as possible. We review your protection plan with you every 3 to 5 years. Now, this is your commitment to your client to ensure that you get the results that you wanted. And we'll provide support to you and your family members in the claims process. One of the most undervalued resources of engaging in a formal long-term care plan is the resources that when it is time to go on claim, you have a number to call. And they will help identify what resources are available in your community. They could just sell that as an insurance policy, and it would be of value. In that, who are the providers? Who are the coordinators in your community? I mean, almost every county in America, they're, at the county level government and in many cities, they have people, they have therapists and counselors that are there to help their citizens identify resources in the community. Where do you get what are the best prices? What are the best facilities? There are placement agencies out there where they work for you. They don't get paid till you get placed, and they're going to help you get placed to the best facilities that they can find. They know all the facilities. That resource that pool of resources that are available because of engaging with professionals, that this is what they do, that is one of the most undervalued benefits of just having any type of long-term care plan in place. Because otherwise your family's on their own, and it's a great big scramble when they're at the hospital and the hospital says, we're discharging your father in 3 days. You need to make arrangements. That's a pretty daunting challenge. What works best? This is too important of an issue to be left to chance. We're full-service financial professionals who can help you determine the strategy that's best for you. Decisions cannot be made in a vacuum. It needs to be coordinated with your overall financial plan. Again, you can't do this in a vacuum. You have questions, we can help. The flip side of that is many people don't even know what questions to ask. And where your value as an advisor is at least having the right questions to ask to help them come to terms with the solution. So please schedule a meeting with us to review your current situation and map out your options. We assist you to make a confident, informed decision that optimizes outcomes for your reasons. again, this is, it's how we approach all of the solutions that we provide to the advisors we work with. It's let's provide the best solution we can for your clients, and that's what we're here to do. That's what you're there to do for your clients. This is too big of an issue to not be addressing with your clients. I think that it ought to be addressed with every client. We have a disclaimer or disclosure page stating that we did address it, that we laid it out, and then if the client declined to take any planning steps towards it, that they acknowledge that. It's important to have that. I think it's going to become more important as the boomer generation crosses over into retirement, and more of them face these types of situations. Any questions?
So we did have a question pop through, Rob. What is the ideal age to purchase LTC if a client is in good health?
So,
did you hear that? Oh, sorry.
Yep. I just flipped to a slide. When on claims, where does claims start? Where do claims end? Why do claims end? Decline rates. So, when applying for long-term care insurance, it's typically some type of an underwriting process. Less than 20% of people are declined after age 50. And let's be clear, when you apply for long-term care insurance, they're underwriting for morbidity, not mortality. They're two very different things. It is not uncommon that we can get someone preferred non-smoker rates for life insurance and they're issued standard for long-term care, or even decline because of bad knee, bad back. That stuff's not going to kill you. So you're going to live a long life, but they don't want to be on the hook for taking care of your bad knee at age 65. I bought mine when I was 46. I would say, anybody over the age of 40 really ought to start taking a look at it. And why? It may seem young. If the client has the means, you're securing much lower rates. It costs a whole lot less at 40 than it does at 50. And 50 is better than 60, and 60 is better than 70. When you get over 70, the amount of leverage that's available is a challenge. So, but typically between ages 40 and 50, the client's got a whole lot of other demands on their financial resources. If they can do it in their 40s, they should. It doesn't get any cheaper. But I would say the ideal time, assuming that they don't have the resources in their 40s, would be between 50 and 55. Again, why? It's only cheap. It never gets cheaper each year you live and apply. And you can see the decline rates as you get older.
Another person asked about the best website to determine costs. I do know Genworth. Is there any other, Rob, that I'm missing? I mean, I think I've seen a couple others.
The website Genworth provides, and it's on our website too. If you have access to our website, that link is on our website under our long-term care tab. That, for me, that's phenomenal. And it's shocking how much of a disparity there is from place to place. Or even in Arizona, for example, I live in Scottsdale, so I thought long-term care in Scottsdale would be ridiculously expensive. Well, it turns out it's actually pretty reasonable in Scottsdale because there are so many facilities and there's lots of competition. If you move north to Flagstaff or Show Low, or out to some of the Prescott, it's a whole lot more expensive because it's remote. There's not nearly as many facilities. So it's interesting, the economics of it. So go to our website or just Google Genworth long-term care price model, and they bring up a map of the United States. You can put in a zip code. You can click on a state. It's very comprehensive.
Awesome. Another question that popped through was, how do I get this conversation started when I've only been managing assets for my clients?
Well, that's a long conversation. I could do a workshop just on that. What I would tell you is, listen, let's follow up with us. If you have a relationship manager at CORE, call in and speak with your relationship manager. If you don't, call in and ask for myself, ask for someone on the case design team, and we will hook you up with resources, conversation starters. We have a lot of tools and resources from the carriers themselves as well as from our experience that we would be happy to help you get up to speed with that conversation.
And your relationship manager, too, I'll add, would be happy to role play with you so you get comfortable. If you feel like you only have time for one or two questions, we can knock it down to that. And those usually lead into bigger conversations. But I know our RMs are all comfortable playing through that with you.
Yep. And if you don't have an RM, call in and our team will work with you and get you up to speed.
It looks like that is all the questions I have right this second. Let me see if any of others have popped through. I think that's about it. One last comment is I will be sending out the presentation, and we also will have this video up on our website. I'll send that link out to everyone at the wrap, okay?
Thank you
so
everybody.
much.
You managed to keep it under an hour. Woohoo!
Have a great day, everyone. Thank you.
Thank you.
Bye-bye.